To be able to discount cash flows, we need an appropriate discount rate, right? The discount factor that takes into consideration both debt and equity investors is called weighted average cost of capital, or simply known as WACC. It provides a sense of the average opportunity cost sustained by financiers for investing their funds in the firm. Let's take a look at the WACC formula. It has two weighting components: debt divided by the sum of debt and equity divided by the sum of debt and equity. The sum of these two components is equal to 1, of course. This shows us that in a firm that is prevalently financed with debt, the cost of debt will have a higher weight. And conversely, if a company is financed mainly with equity, the cost of equity will have a higher impact on WACC. We shouldn't forget to mention that the cost of debt component includes a third factor, 1 minus t, that takes into account the fact that interest expenses are tax deductible, and hence the cost of debt of the firm is lower than it seems. In the WACC sheet, we have the following. First, we've copied some of the important inputs we'll need for this calculation: cost of debt, risk-free rate in Vietnam at the moment of performing the capital budgeting exercise, our tax rate, and the market risk premium in Vietnam. If some of these terms sound unfamiliar, don't worry, as we will explain them in more detail in our next lesson. Below, we have a table that compares the leverage and beta of comparable companies. All of these inputs are from our drivers sheet. This is intel collected from our operations team. Then we've created a table that shows us the total financing of the project, both equity and debt. This table allows us to calculate the percentage of equity and the percentage of debt that's been used in a given year. Therefore, it shouldn't be too difficult to substitute for most values in the formula. We already have the percentage of debt and equity financing. The cost of debt is 5%. The tax rate is 30%. All we need at this point is cost of equity. Right. And how do we estimate the cost of equity? Well, we'll see that in our next lesson. Thanks for watching.